Whenever the RSI goes above the 70 or 80 level, most traders immediately assume that the market is overbought and they start selling. And whenever RSI falls below 20, many retail traders take it as an oversold condition and blindly jump into buying. But here's the problem. Quite often, even when RSI is in the overbought zone, the price keeps moving higher with strong momentum. And many times, even after RSI shows oversold, the market continues to drop further. If you've also been using RSI in this way, then honestly, you've been using it wrong. But I don't blame you, because on the internet, in most trading videos, this is exactly how RSI is explained. In this video, I'm going to show you how RSI should actually be used in a professional and practical way. Not only will we cover the basics, but we'll also go into the advanced side of RSI, including the powerful concept of RSI divergence. This is going to be a complete RSI masterclass. By the end of this session, you won't need to watch any other RSI tutorial again. And even if you think you already know RSI, I want you to watch carefully, because what you think you know might actually be wrong. Also, don't underestimate RSI. It's not a small or simple tool. Once you truly master it, you can build multiple powerful strategies around it. So, let's start the video. The full form of RSI is the Relative Strength Index. This indicator was created by a mechanical engineer named J. Wells Wilder back in 1978. Along with RSI, he also developed other popular indicators like parabolic SAR and ADX. So, what does RSI actually do? RSI helps us understand how strong price movements are at any point on the chart, the momentum of the price, and how quickly the price is moving. In simple terms, it shows us the speed and strength behind market moves. Now let me show you how to apply RSI on a chart and understand it properly. First, go to the Indicator section in your trading platform. Type RSI in the search bar. This is the Relative Strength Index we want to apply. Click on it, and immediately the indicator will appear on your chart. When it first appears, it may look like a simple line graph below the price chart. Don't worry. We'll break down what each part represents so you can read it easily and use it effectively in your analysis. But here's the most important point. Before you start thinking about overbought or oversold zones, you first need to understand how RSI actually works. Without this understanding, all the signals you see on the chart might be misleading. RSI is based on a simple mathematical formula, but what really matters is the logic behind it. Essentially, the formula uses two main components: average gains and average losses. Let me give you an example. Suppose we are using a 14-period RSI. To calculate it, the indicator looks at the price movement over the last 14 periods. Out of these 14 periods, let's say the price increased on 6 days. These are counted as the gains. On the remaining 8 days, the price decreased. These are counted as the losses. The RSI is calculated by taking the average gain over these 14 periods and dividing it by the average loss, which gives us a ratio that represents price strength and momentum. This is why RSI is so powerful. It doesn't just show you if the market is overbought or oversold randomly. Instead, it reflects the real strength of price movements over the chosen period, and it helps you gauge whether momentum is increasing or decreasing. So next time you see RSI above 70 or below 30, you'll know exactly why it's there, and you'll be able to interpret it with confidence rather than just guessing. Now that you already know how to add RSI to your chart, the next step is to actually understand what it tells us. You don't need to calculate it yourself every time. The platform does that automatically. The calculation I explained earlier was just to give you a background idea. So RSI always moves within a fixed range, from 0 to 100. It can never go below 0, and it can never go above 100. Inside this range, there are 3 important levels that you should always keep in mind: 30, 50, and 70th. Let's start with the 50th level. If RSI is trading above 50, it generally suggests that the stock or the asset is in a bullish phase. Buyers are stronger and price momentum is upward. On the other hand, if RSI is below 50, it indicates a bearish phase. Sellers are stronger and price momentum is downward. Now coming to the 70 and 30 levels. Most traders believe that when RSI goes above 70, the stock is overbought and will reverse downward. And when RSI falls below 30, the stock is oversold and will bounce back upward. But here's the reality. That assumption is not always correct. Just because RSI crosses 70 does not guarantee that the price will fall. And just because it touches 30 doesn't always mean the price will rise. Many times, a stock can remain above 70 for a long period if it's in a strong uptrend, and it can stay below 30 for a long time if it's in a strong downtrend. That's why, instead of treating 70 and 30 as automatic buy or sell signals, you should treat them as warning zones. They tell you that the price is stretched and now you need confirmation from price action or other signals before making a decision. So what's the correct way to read it? RSI is considered oversold only when it first goes below 30 and then turns back up, crossing above 30 again. That's the signal that the stock is coming out of the oversold zone and could start moving higher. And RSI is considered overbought only when it first moves above 70 and then turns back down below 70. That's when you can say the stock has lost momentum and might start falling. This is where most beginners go wrong. They act too early. But now, you know the difference between just crossing a level and actually reversing from it. So now I believe you've clearly understood the basic meaning of RSI levels. Here's a quick challenge for you. If RSI is above 50, what does it mean? If it's below 50, what does it mean? If it crosses above 70, what does that tell you? And if it drops below 30, what does that tell you? Pause this video right now. Drop your answers in the comments. And once you're done commenting, let's continue with the next step. Now let's talk about RSI double top and double bottom patterns. By the way, very soon a completely free course on chart patterns is coming to this channel, where I'll explain all of them in detail. So make sure to subscribe right now so you don't miss it. Let's quickly understand what these patterns mean on a normal price chart. A double top forms when the price goes up, creates one top, pulls back, then rises again to the same level, and creates another top. After this, the price usually has a higher chance of falling. A double bottom is the opposite. The price goes down, takes support, moves up, comes down again to the same support level, and then bounces back upward. After this, the price usually has a higher chance of rising. But here's the interesting part. These same patterns can also form on the RSI indicator. For example, if RSI drops below the 30 level and forms a bottom, then rises a little, and forms a second bottom near the same level, that's a double bottom on RSI. Now, if RSI then climbs back above the 30 zone, we can say the stock was in an oversold zone, and there's a strong chance of upward movement. As you can see on the chart, whenever this happens, the price often rises afterward. But let me make this very clear. It doesn't work every single time. That's why it's best to confirm with a bullish candlestick pattern along with the RSI signal. And don't worry, I'll soon make a detailed video on candlestick patterns as well. The link will be added in the description once it's live, so make sure to check there. So now you've learned how the double bottom pattern works on RSI. Next, let's move on to understand the double top pattern on RSI. Now, as you can see here, the RSI had moved above the 70 level and created a peak. Later, it formed another peak around the same level. This is what we call a double top pattern on RSI. And right after this, the stock price started to fall. In the same way, we can also identify double bottom patterns on RSI. These patterns give us an early signal of possible price reversals. So far, you've learned what RSI basically means, how to use it, and how to identify double top and double bottom patterns. Now let's take this to the next level and understand RSI divergence. Generally, stock price and RSI move in the same direction. If the price is rising, RSI also rises. And if the price is falling, RSI also drops. But sometimes you will notice something different on the chart. For example, if the stock price is falling but RSI is rising, this is called a bullish divergence. It means that even though price is dropping, RSI is showing strength. This indicates that the trend might soon reverse upward and the price has a higher chance to move up. On the other hand, if the stock price is rising but RSI is falling, this is known as a bearish divergence. It tells us that the trend is losing strength and the price has a higher chance of moving down. As you can see in this example, the price was falling, but RSI was climbing higher. This was a bullish divergence, and soon after, the price went up. Similarly, in this case, the price was rising while RSI was falling. That's a bearish divergence, and eventually, the price dropped. So now you clearly understand what RSI divergence is and how it signals possible reversals. Now, before we talk about trading, there's one important thing to keep in mind. If you ever notice a divergence on the chart, don't just rely on that alone and immediately jump into a trade. That's risky. Instead, you should always confirm it with candlestick patterns. For example, if you see a hammer candle forming right at the divergence, that's a bullish confirmation signal. Only then you can feel more confident about the setup. By the way, I've already made a complete masterclass video on the hammer candle. You can watch it by clicking the I button above. Now let me ask you a quick question. What do you think should happen for a bearish divergence? Comment your answer below. I'd love to see your thoughts. And of course, if you're finding this video valuable, make sure to hit the like button and don't forget to subscribe to the channel for more trading content. All right, now let's discuss time frames. Because RSI works differently depending on whether you're intraday trading, swing trading, or long-term investing. For intraday trading, you can use 5-minute, 10-minute, or 15-minute candles. For swing trading, the 1-hour time frame works well. And if you're looking for bigger swing moves, you can also use the daily candles. Finally, for long-term investing, you can analyze the RSI on weekly candles. So this was the basic idea of time frames. But trust me, there's a much more powerful way to use RSI with multiple time frames, and that's what we're going to explore next. So if you ever notice on the weekly chart that the RSI breaks above the 50 level, remember, 50 is the mid-zone. It usually signals that the stock has turned short-term bullish. On the other hand, if the weekly RSI drops below 50, it indicates short-term bearish momentum. Now, if we shift to the monthly chart and the RSI is above 50, that suggests long-term bullish momentum. But if it's below 50 on the monthly time frame, the stock is in long-term bearish momentum. Here's an important multi-time frame combination. If the weekly RSI is between 50 and 100, while the monthly RSI is above 70, the stock is showing strong bullish momentum. But if the weekly RSI is between 0 and 50, and the monthly RSI falls below 30, that signals strong bearish momentum. And finally, if both the weekly and the monthly charts show RSI above 70, that's an extremely strong bullish trend. Conversely, if RSI is below 30 on both time frames, it indicates an extremely strong bearish trend. By analyzing RSI across multiple time frames like this, you can get a much clearer picture of the overall market trend. So, this is how you can use RSI across multiple time frames to understand the true market trend with much more clarity. I hope you found this video valuable. If you did, make sure to hit the like button and subscribe to the channel to support us. Thank you for watching.